bonds with a par value of $570,000 on their stated issue date. The bonds mature in 9 years and pay 8% annual interest in semi-annual payments. On the issue date, the annual market rate for the bonds is 10%. What is the amount of each semi-annual interest payment for these bonds? We multiply the par value, $570,000, by the semi-annual contract rate of 4%. The semi-annual cash interest payment is $22,800. How many semi-annual interest payments will be made on these bonds over their life? There will be 2 payments per year for 9 years, a total of 18 semi-annual payments. Use the interest rates given to determine whether the bonds are issued at par, at a discount, or at a premium. There are always 2 percentages associated with bonds. The contract rate determines the amount of the semi-annual cash payments. The market rate determines how much an investor is willing to pay to receive those cash payments. When the market rate is equal to the contract rate, bonds sell at par. When the market rate is less than the contract rate, investors will pay more for the bonds. The bonds will sell at a premium. When the market rate is more than the contract rate, investors will pay less for the bonds. The bonds will sell at a discount. In this case, because the market rate, the true interest rate, is 10% and the contract rate is only 8%, we predict that this bond will sell at a discount. So now let's compute the price of the bonds as of their issue date. Bonds sell for the present value of the future cash flows. The factors on the present value chart will be based on n equals 18, as there are 18 semi-annual cash payments, and an interest rate of 5%, the semi-annual market rate. The cash flow promised by this bond consists of a single payment of $570,000. The table value is found on Table B1, the present value of $1. We go to the intersection of 5% and n equals 18, and we find a factor of 0.4155. We multiply this table value by the amount of the future payment, $570,000, to calculate the present value of the payment, $236,835. One payment of $570,000 at the end of 9 years is the equivalent of 0.4155 payments of $570,000 today. The bond also promises to make semi-annual cash interest payments. This series of equal cash payments is referred to as an annuity. We go to Table B3, the present value of an ordinary annuity, and go to the same intersection, 5% and n equals 18, and the factor is 11.6896. We multiply the table value by the semi-annual payment, $22,800, to calculate the present value of the payments, $266,523. 18 payments of $22,800 spread out over the next 9 years is the equivalent of 11.6896 payments of $22,800 today. The total present value, the issue price of the bond, is $503,358. The bonds do in fact sell at a discount. Prepare the journal entry to record the bond's issuance. Debit cash for the issue price, $503,358. Credit bonds payable for the par value, $570,000, and debit the contra liability account, discount on bonds payable for the difference, $66,642.